Imagine for a moment sitting at a long wooden table in a room that smells faintly of coffee and late-night briefings. Around you are lawyers, customs brokers, supply chain wizards, and someone who quietly manages multi-jurisdictional cash flows, the kind of team most people only ever see in movies. What they know, and what very few retail investors grasp, is that international trade is not just about moving boxes across borders. It is a sophisticated ecosystem of rules, exceptions, timing, and perception, and inside that ecosystem are levers that create outsized advantage. The ultra-wealthy don't simply sell more widgets, they design the path those widgets travel, so tariffs, duties, and cross-border taxes become features of profitability rather than costs. That's the paradox. What looks like friction to most businesses becomes an opportunity to optimize margins, preserve cash, and engineer competitive moats when you understand the levers and respect the law. In this first part, we'll strip away industry jargon and reveal those levers, not to teach illegal avoidance, but to show you how policy, logistics, and finance interact to shape who wins and who pays. The mechanics are deceptively simple and secretly complex. At the center are classification and valuation, those dry HS codes and declared customs values that determine how much duty a shipment pays. Change a product's declared tariff classification within legal bounds, and you can swing a bill by tens of percentage points. Add in rules of origin from free trade agreements, and the same product can qualify for preferential rates just by changing where a component is sourced. Then there are special regimes, bonded warehouses that delay duty payments until goods are sold, free trade zones that allow processing without immediate import duties, duty drawback programs that refund import duties for exported goods. Combine those with smart timing, moving goods across borders at specific points in a product life cycle, and you create a cash flow advantage. Behind every move sits compliance work, audit trails, and legal opinions. These aren't tricks, they're expensive expertise. Quick pause. If this perspective is useful and you want future dissections and real-world examples, hit subscribe now so you don't miss part 2. Beyond customs paperwork lies the financial architecture that magnifies advantage. Trade finance tools like letters of credit, receivables financing, and staged payments change who carries the capital risk and when. Large groups use internal transfer pricing and captive logistics companies to allocate margin across jurisdictions, then pair that with currency hedges to lock in predictable returns. They structure supply chains, so tariffs act as predictable inputs into price models, not volatile surprises that eat margin. Political influence and regulatory engagement, lobbying for beneficial tariff codes or carve-outs, is another lever too few consider when valuing a company. Imagine a luxury brand that negotiates a bespoke tariff classification for a small component. The cost savings compound over millions of units and quietly fatten margins year after year. All of this requires discipline, documentation, audit readiness, and, crucially, legal clarity. The line between clever optimization and illegal evasion is bright and enforced. The players who succeed are those who invest earlier in compliance than their competitors. So, what should an investor, analyst, or curious viewer take away from this? First, look beyond headline revenues. Study gross margins, note disclosures about customs and duties in the 10K or annual note, and watch for companies that highlight trade-friendly operating models, bonded logistics, regional manufacturing hubs, or captive freight subsidiaries. Second, the opportunity set includes infrastructure and service providers that enable these strategies, ports, warehousing firms, customs brokers, trade insurance, and fintech lenders who underwrite trade flows. Third, understand the risks. Tariff policy can shift overnight with politics. Reputational risk from aggressive tax posture can erode brand value, and regulatory audits can impose retroactive bills plus penalties. Finally, treat this knowledge like a lantern in a cave. It reveals hidden contours, but doesn't it replace the need for professional counsel? Over the next parts, we'll translate these concepts into red flags to watch in filings, sector-specific case studies, and simple signals you can use to build a watch list. For now, let this sink in. Where ordinary businesses see a tax, the informed see a mechanism that, when used lawfully and intelligently, can be transformed into enduring economic edge. Imagine the lights going down and you standing with a spotlight on a single shipping container. For most people, that container is anonymous freight. For the informed investor, It's a ledger of choices, costs, and control. In this final chapter, we pull those threads together and turn them into practical action steps you can use immediately. Remember, the goal here is never secrecy, it's clarity. When policies, logistics, and finance align, a company's margins and predictability change in ways that show up in plain sight if you know where to look. We've already seen the mechanics: tariff classification, rules of origin, bonded warehouses, duty drawback, captive logistics, and trade finance. So now I'll translate those mechanisms into investor signals, red flags, and tradable ideas. This is the part where strategy becomes checklist, where curiosity becomes conviction. Feel the urgency. Markets reprice fast when regulators or competitors catch up. The edge belongs to the disciplined researcher who reads footnotes like a detective, listens to quarterly calls like a spy, and treats regulatory filings as treasure maps. First, the checklist. Concrete things to scan in every company you research. Start at the top line, but don't stop there. Compare gross margins by region and product line over multiple years. A quietly improving margin in an export-heavy region can be the fingerprint of trade optimization. Read the notes for customs and duties, cost of goods sold, and any references to bonded facilities, free trade zones, FTZs, or duty drawback programs. Those are explicit signals. In the MD&A or management discussion, listen for language about regionalized manufacturing, in-country value additions, transfer pricing with captive logistics, or trade-related working capital. In the balance sheet and contingencies, watch for unusual receivables from related parties, recurring changes in inventory classification, or large, unexplained movements in payable timing that might indicate clever cash flow structuring. On earnings calls, ask, or note whether analysts ask, about where final assembly occurs, whether components are imported under preferential trade agreements, and the company's exposure to tariff reclassifications. Outside filings, track physical signals: a company buying land near a major port, investments in bonded warehousing, or new contracts with third-party logistics firms. Infrastructure speaks volumes about intent. Keep a short trade advantage scorecard for each company: disclosure quality, operational signals, legal opinions cited, and margin sustainability. High score, equal, potential structural edge; low score, equal, either no edge or high opacity. Both are investable, but in different ways. Second, tradable angles and risk controls you can actually use. There are 3 pragmatic buckets. A. Direct plays on companies that net real, documented benefits. Think manufacturers that move value-adding steps into FTZs or leverage duty drawback consistently while keeping impeccable disclosure and audit trails. B. Service provider capture. Customs brokers, bonded warehousing operators, 3PLs, freight forwarders, trade insurance underwriters, and fintech lenders who finance cross-border flows. These businesses often enjoy recurring revenue and secular tailwinds as global trade complexity rises. C. Event-driven and macro overlays. Tariffs and trade policy move in political cycles. When a tariff is announced, there are short windows to trade equity, credit, or options in suppliers and their customers. But here's the discipline that separates winners from gamblers. Always model downside scenarios where a policy reversal, an audit, or reputational shock wipes out the expected margin lift. Use position sizing rules that cap exposure to any single regulatory outcome and hedge when the market underprices policy risk. Avoid companies that rely on opaque rulings, frequent retroactive reclassifications, or heavy related party flows without clear external audits. Those are the names most likely to produce retroactive liabilities and nasty headlines. Finally, think in terms of compounders. Small percentage improvements in duty or timing compound dramatically across millions of units. Favor businesses where scale amplifies these savings predictably and legally. Lastly, the operational playbook for a smart investor who wants to make this actionable tonight. 3 simple steps. 1. Run a cross-sectional screen of your universe for companies with improving regional gross margins and either growing inventory in FTZs or capital expenditures in logistics infrastructure. 2. Read the latest annual report footnotes for language about duty drawback, bonded warehouse, free trade zone, and rules of origin, and flag those with clear, consistent disclosure. 3. Build a monitoring alert for tariff policy headlines in the countries that matter to your holdings, and pair that with a volatility trigger for hedges. Combine that with a daily habit. Spend 10 minutes scanning procurement and supply chain sentences in quarterly filings. The details are where durable edges hide. Above all, maintain humility and legal prudence. Nothing in this lesson is advice to dodge taxes or breach laws. The ultra-wealthy advantage is not a loophole to exploit recklessly. It's the disciplined application of law, logistics, and finance inside transparent governance. Consult customs counsel, tax advisors, and trade auditors before assuming any company's advantage will persist. So what do you do next as an investor school viewer who wants to act? Bookmark one company you think might be benefiting, apply the checklist I gave you, and write down a short thesis. How the trade mechanism converts into margin, the likely policy tail risks, and the catalyst that would prove the thesis right or wrong. Opportunities like these are scarce, and they reward preparation. The best investors don't discover edges by accident. They build the habits that find them. If this series sharpened your view, subscribe, hit like, and share this with one person who tolerates long-form ideas. I promise the next deep dive will convert curiosity into clear tactics you can use. Until then, keep your ledger clean, your questions sharp, and your skepticism healthy. And remember, in global trade, what looks like a tax to one company can be a foundation for advantage to the company that planned for it years ago.